Hello, I'm Chip Stites, and this is The Laughing Retirement. Now, one of the things that I know to be certain, because I've seen it over the last 50 years or so, is that people are much more likely to be relaxed and to laugh and to enjoy themselves when they feel in control. But a lot of times, when things are changing quickly, we don't feel like we're in control of our investments. So we get worried and we get nervous. And you know what? I don't blame you. So today on The Laughing Retirement, we're going to talk about risk and controlling it and how. And we're going to get into the weeds a little bit, but I don't want that to put you off because you know what? Investing isn't difficult. It's human beings who make it difficult. And because there's an entire industry out there that wants to make money from you, you've got to know what you're doing so that you can make money for you. Okay? So let's get started. Right now, we're going to take a look at risk. Why less is more return, that is. I think we look at risk the wrong way, completely wrong way. We are told that more risk equals greater return over time. Nothing could be more accurate. Because if we knew what the stock market was going to do over time, everybody would be rich, wouldn't they? This is easy. We know what to do. We know where to go. We know what to buy. There you go. We don't, unless, of course, you're in Congress and you know what's going to happen beforehand. But for the most part, you and I, we don't know. So let's talk about risk and how to handle it right, and how to make you feel comfortable enough so you can do a little laughing and enjoying yourself and not worry about money. Now, what is risk? Risk is the possibility that an investor will lose their money when investing in an asset. As investments rise, investors expect more return, as investment risks rise, investors expect more return for their money. But remember, we don't know what's going to happen in the future. We're just told to expect that. So if I'm taking more risk, I want more return. Well, that's true. But you don't know that if you take more risk, you're going to get more return. So I think the best thing to do is to opt for consistency. And we're going to talk about that. But as your investment risk rises, your time horizon has to go out too. And we don't always have a combination of willingness to take risk and a time horizon at the same time. It's not like we're 30 anymore. So I want to give you a way when you're 50, 55, 60, 65, 70 to handle risk. I'm 77 years old, and I'm pretty careful with my risks. How do you properly control your risk? Well, first you have to know what your goal is. You have to know what exactly you are trying to accomplish. Now, I know you put money in, you want to be able to take more out. And that's a fairly common goal. But unless it's quantifiable, unless you can repeat it over and over again, unless it makes sense to you, just putting money in and expecting more later is a bad idea. Especially the consideration that you have three things working against you before you start. You've got taxes, inflation, and the cost of investing working against you before you even put a nickel in. So you have to be careful with what you're doing. And you have to know what your goal is. Well, here's your goal. Your goal is taxes plus inflation plus the cost of investing plus 1 to 3%. Now, I know you're used to hearing, well, I want 10%, I want 20%. The market does 11%, so I want 15. Well, all that's marvelous. All that's very good. Except that to win, you need consistently to earn more than taxes plus inflation plus the expenses that you incur in order to invest. Now, which of these can you control? You can't control taxes. You can vote, but you can't control them. You can't control inflation, but you can control the expenses that you have when you're investing. And we're going to talk about that. Do those expenses cost you much? Well, according to John Bogle in his testimony before Congress in September of 2014, your expenses that you are paying for mutual funds and an advisor can cost you as much as 65% of what you might otherwise earn. So if you earned $1, you most likely would have earned $1.65 without the expenses you had. So expenses become important. Now, how do you get that? If you want to have lower risks and more consistency, how do you take care of all your expenses? How do you take care of taxes? How do you take care of inflation? Well, first of all, there's no investment that has zero risk. And when you look at it, there isn't anything you're putting your money in that has zero risk. A savings account is backed up by the bank and the FDIC. But the FDIC doesn't have a lot of money to pay off your investments quickly. Some people have waited 6, 8, 10 months in order to get their money when a bank failed. A CD is fine, but does the return of the CD equal taxes plus inflation plus 1 to 3%? Because I know that a return on a savings account doesn't. Government money markets don't generally pay that much. Your principal is going to be safe in those things, but you're not going to earn enough to make taxes plus inflation plus the expenses of investing plus 1 to 3%. Now, Warren Buffett says that bonds and fixed accounts are a good way to go broke safely. I think he's right over the long haul. A U.S. Treasury bill for 30 days has less interest rate risk, but there are still risks that are there. I mean, the government can default. As a matter of fact, you're looking at the value of the dollar fall right now because people are worried about the government being able to pay for its debt. There's interest rate risk. You buy something you buy a CD for 6 months, and halfway through the 6 months, interest rates go up. So you lost, for the 3 of the 6 months, you lost money. Interest rate risk, purchase power risk. The fact that when you're done with something, your investments don't buy as much as they used to. The problem with these investments is that they seldom make our goal. Our goal is taxes plus inflation plus 1 to 3%. Taxes plus inflation plus the cost of investing plus 1 to 3%. Those are our goals. Now, government notes and bonds. Notes are 2, 3, 5, 7, and 10 years long to maturity. Bonds are 30 years or more. Interest rate is paid every 6 months. There's some default risk, but we generally, if Congress doesn't raise the debt ceiling, we default. But after wrangling, they always do. Selling before maturity also gives you a risk of capital. In other words, I bought a treasury note, for 5 years, but I sold it at 3. Now, I can lose money there because if interest rates are higher, they're going to pay me back less. If interest rates are lower, they're going to pay me back more. So there is risk in selling early. There's risk if interest rates rise. So that's interest rate risk or purchase power risk. So U.S. notes and bonds don't always solve the problem. So what are the different kinds of risks that we're talking about? Well, there's systematic and unsystematic risk. Systematic risk is kind of like market risk. Think of it that way. The risk that the markets will lose money and that what you have your money in will be part of that loss. This type of risk is difficult to diversify away from. In other words, when they tell you the way of getting rid of risk is to diversify more, that's partially correct. It's also partially incorrect because you can't get rid of risk by diversifying. There's interest rate risk, inflation risk, currency risk, liquidity risk, country risk, socio-political risk, which is geopolitical risk. The geopolitical risk would be buying a factory in Ukraine, and it gets bombed and the company is destroyed. Now, unsystematic risk is risk related to a specific company or a specific industry, like a product recall or government change in regulation or a drug failing its FDA tests. Diversification works well against this kind of risk because if I buy 60 stocks and they are well known and been around for a long time, the likelihood of any of those companies failing is small. On the other hand, if I buy a startup chip company, the likelihood that that company will fail by comparison to something like Johnson & Johnson or AT&T is relatively small. The chances of the larger, older company failing is relatively small compared to the brand new AI chip maker. So there's different kinds of risk: systematic market risk, business risk, and unsystematic risk. Now, let's look at risk and reward. This is what we're told. This is what we're taught. We're taught that the greater the risk, the more return you should get for that risk. Logical, certainly makes sense. But at the same time, you have to have more time to let the riskier stock develop. But from what I've seen in almost 50 years of investing, I think it's 47, since I started in the financial services industry, what I have seen is that consistency makes a great deal more sense than increasing risk and expecting more return. Because when you increase your risk and you have to go out farther in time in order to expect a higher return, you're risking more. And you still don't know what you're going to get because nobody can predict the market. It makes greater sense and greater probability of consistent positive returns by taking less risk. So the idea that we want to take more risk to get a greater return, I don't think always makes sense. I think it was Mark Twain who said something like, it was Mark Twain while he was a comedian. I'll think of it. But he said, I'm not worried about the return on my money. I'm worried about the return of my money. He's not the only one, as comedian, I'll think of it. He's not the only one who feels that way. You want your money back plus some. That's the whole purpose of investing. Now, what is risk management? How do we do it? Well, there's three words that I want to give you, and we're going to get a little bit into the weeds here. One is beta. Beta is a measurement of your investment against the movement of the S&P 500. So if my investment does this, and the S&P 500 does this, my beta is going to be low because my price does not move around as much, is not as volatile as the S&P 500. So I'm always looking for things that have a low volatility, a low beta, and a high dividend. And very simply, once you find beta greater than 1 is more risk than the S&P 500. 1 is the same risk as the S&P 500. Less than 1 will gain or lose more, or gain or lose less than the S&P 500. And negative to the index means that the stock, the investment, will move opposite to the index sometimes, most of the time, and is not correlated to the index. So you're buying something that is different. You're buying what I call an offset. We'll talk more about that later. Sharpe ratio. The Sharpe ratio just tells you, is the risk worth the reward? If the Sharpe ratio is a positive number, then it is. If it's a negative number, then it isn't. That's not difficult. Beta is not difficult. Less than 1 is more consistency in your investment. More than 1 is greater risk and less consistency in your investment. A negative number in beta means it's going to move opposite the S&P 500. So it offsets some of the S&P 500. Now, what's alpha? Alpha measures the investment returns greater than the benchmark index. So if I've got a high alpha, that means that I'm taking some risks of the S&P 500, but I'm getting more returns than that if my alpha is high. And my benchmark is the S&P 500. So if my returns for the risk I'm taking are greater, my alpha is going to be higher. So what do you want? You want a low beta, and you want a positive Sharpe ratio and a positive alpha. That's all. It's relatively simple. This stuff ain't difficult. It doesn't take a genius. I can tell you the difference between positive and negative numbers. I can tell you when a number is higher or lower than 1. So all I have to know is, what is the Sharpe ratio, what is alpha, and what's beta? That's all I got to know. Now, it may seem foreign to you because you're not used to the words. But the fact is that those 3 words will serve you very, very well when it comes to being successful in investing. Now, how much can you manage? How can you manage the risk in your portfolio? Well, we just talked about it. We can keep our beta low. We keep our alpha and our Sharpe ratio positive. And we buy things that people must use. When you walk in your house, what's the first thing you do? You flip on the lights. You're not going to walk in the house and say, well, the market's down, so I'm not going to turn on my lights. You don't walk in the house and say, well, the market's down, so I'm not going to turn on the heat. You don't walk into the grocery store and say, the market's down, so I'm not going to buy butter. You still buy the butter. That's why I like owning utilities. I like owning food. I like owning gas for heat because people use it every day. And that's not likely to change. So if these measurements are all positive, even in heavy downturns, you will do better than the market does. And after all, since I can't stop the downturns, as long as you always do better than the market, aren't you doing okay over the long haul? Aren't you winning the battle? Taxes plus inflation plus the cost of investing plus all you need to make after your expenses is 1 to 3% to stay ahead. That's all you need to make. And you can manage your portfolio to make that, to keep your beta low, and to keep stocks that outperform their benchmarks. Okay, so how do we do this in our portfolio? Well, when you look at a stock, you start with a low beta and a low risk level. If you see a stock that has a risk history that you want, and the beta and the alpha are positive, this information is easily found with 2 clicks of the mouse in Schwab. Once you get to your screeners, it's not difficult. Method number 1 that we use when we are diversifying our portfolio to proper risk management is making sure that the stocks we are buying are in the right place to start with. The second thing is making sure that the stocks we are buying have the right diversification among them. And there's at least 2 kinds of diversification. One is the diversification within our country, and the other is the diversification outside our country, and the other is the diversification of the different kinds of assets that we hold. And we can show you all this. It's easy. How much do you save when you start doing things yourself? Well, according to John Bogle, the founder of Vanguard, the average investor loses 65% of what he might otherwise save on expenses and fees. He said that to Congress. Did it make any difference? No. Because the financial services industry has a gigantic lobby. Taxes plus inflation plus the cost of investing, plus 1 to 3%. And you can control the cost of investing. So, proper diversification. We have multiple asset classes, and this includes currency, this includes precious metals, this includes U.S. versus foreign stock, this includes normal U.S. stock. Then there are the sectors for normal U.S. stock. The economy has 11 sectors. 1 or 2 or 3 stocks in every sector solves the problem, at least for diversification inside the United States. Then there are, when we start buying ETFs, is a problem called overlap. We want to make sure that we don't overlap. For instance, I can't tell you how many times I've had a portfolio come into me and I see they own the S&P 500 ETF, VOO, that's Vanguard's S&P 500. And then they go out and they buy total world stock market. They have the S&P 500 and the stuff in the total world. And then they go buy sector fund, like utilities. Well, VOO has all the utilities in it from the S&P 500. Now you've got overlap in 3 different places. So all you've done is increase your risk because you're not getting the diversity you think you're going to get. Avoiding overlap is important. Avoiding overlap also saves you money because you're not buying as many different things as you think will give you value, but don't. Now, what else helps diversification be successful? Well, if you set it up properly, you let your portfolio run for a while, say a minimum of 6 months to a year minimum. Let time work for you. History proves that less turnover, buying and selling and buying and selling, improves your returns over time. Read John Bogle. Read the Little Book of Common Sense Investor. Making changes creates risk. It doesn't lower it. And yet we buy mutual funds that have 40, 50, 60% turnover, which means that every time you buy something, you're making a decision what to buy. But every time you sell something, you're making 2 decisions. The decision on what to sell and then what I'm going to do with the money when I got it. So you're selling this because it's not going to do well in the future. And you're buying that because you think it's going to do better in the future. And since none of us can see the future, you're buying and selling and buying and selling. Give your assets, the things you thought were good, the chance to do their job. More money is likely to be made in a portfolio from year 7 to 10 than it is in year 1 to 2. Give yourself some time. When I started in this business, the average turnover was every 5 years or so. The holding period for a stock was about 5 years. Now, it's about 5 months. Doesn't even have time to develop. Every time somebody trades, they make money. You don't. When you trade, somebody else makes money. You start again at the bottom. Does that make sense to you? Give yourself time. Don't trade. Give yourself time to create something that works. Now, I'm talking about individual stocks here, and the average person can manage 30 to 60 individual stocks, and I have the spreadsheet to show you how to do it without any trouble. Trust yourself. Trust how you do things. Trust the process that we have. Give yourself the time to succeed. Now, the results. Proper diversification lowers risk and ensures future returns over time. Lower risk avoids losses, even helps create positive results when indexes are negative. And I'll give you a simple thing here in my case. In 22, PI was up 3.2% when the S&P made 18.9%, minus 18.9%. In 23, I was up 0.3%, and the S&P was up 21.9%. So who did better? The guy who made pokey, very little, or the person that went up 18% or went down 18, 19%, and then up 21%? Who made more? I can tell you right now, it wasn't the guy who took all the risk. It was the guy who didn't take much risk. So if I take the S&P 500 and I put those numbers into it on $1,000, I have $988. If I take the PI portfolio, the perpetual income engine, my portfolio, if I take that and I put it in with those numbers, 3.2% and 0.3%, I have $1,035.09. Whereas with the S&P returns, I have $988.61. You see, consistency has value. Don't lose money. Sounds like Warren Buffett. Now, what's the problems with mutual funds and ETFs? I encourage anybody who has ever invested anything to read a prospectus. As a matter of fact, when I first got in the business, my mentor, a guy named Win Capps, who did it, that guy taught me more in a shorter period of time than took me years to learn how right he was. Fund managers are allowed 20 to 30% discretion on what they buy. If I've got a multi-billion-dollar fund, I have to buy hundreds of thousands of dollars worth of product to make to move the mutual fund in the right direction. So when they buy them, even though the stock has nothing to do with the objective in the portfolio, it's called window dressing. Because portfolio managers have to show you what they're buying every quarter. So if they're in utilities and they got a 30% discretion and NVIDIA and AI stocks and Google and Tesla are the popular stocks in the moment, that utility fund is liable to have those stocks in it. And so are most of the other funds who are also doing the same thing, buying the same stuff. That's because, number one, they don't have a lot of choice. They have to be able to buy enough of it. And number two, everybody wants to see that their funds are properly diversified, but it's exciting to see that your fund has the stuff that's going up too. And so you have one fund over here whose 30% contains NVIDIA, Google, Tesla. And you have another fund over here with a completely different purpose. 30% of it has NVIDIA, Google, and Tesla. So there's an overlap problem with mutual funds. And when there's a lot of overlap, there's a lot of increased expense. Now, what do you do in times like this, when the markets are high? Well, you close the gates a little and you watch what you're doing. You keep your beta low and your positive and your Sharpe ratio and alpha high, beta less than 0.6%. You spread your risk by diversifying across asset classes, across different countries, and across different types of asset classes, as in currency as well. Lower and eliminate your expenses. Opt for stocks and ETFs, no mutual funds, stocks and ETFs with expenses of less than 0.05%. If I have $100,000, 0.05% is $50. If I have $100,000 and my manager, my financial advisor costs me 1%, and my annuity and my mutual funds and everything else costs me another percent, that's 2%. 2% of 100,000 is 2,000. So in my case, I have to overcome $50. You have to overcome 2,000 before you make any money. Wouldn't that save you some money? To be able to have less risk, more consistency, and not to worry about where your money was. Well, when you learn these simple things, 4 or 5 clicks of the mouse, you're going to save yourself some money and you're going to sleep better. Now, what steals momentum and positive gains? High turnover. If you have turnover more than 5 to 10%, other people are making money on the turnover, not you. Expenses. Expenses reduce your return dollar for dollar. So if I have something that's 1% expensive, they have to earn 1% before I earn a nickel. Your investments must first pay themselves. If you invest in individual companies, they don't have to pay themselves first. You don't have a charge for doing that. It's free. Manager overlap. You don't want everything concentrated in specific areas. In 1998, when I was first looking at this and reading about the dot-com bubble and realized that a bubble was coming between 1998 and 2000, I sold every fund I had with the dot-com in it. So as a result, my clients did not drop anywhere near what the S&P 500 and the Russell and other indexes dropped. I dropped about half of what they dropped and had my money back earlier for most of my clients. The difference was very simply, I wasn't over-concentrated in the area that was the problem. Now, Warren Buffett, John Bogle, and William Graham, they all say the same thing over and over again. Rule number one is don't lose money. Rule number two, don't forget rule number one. William Graham, limit how much you are willing to pay. And he calls it a low multiple of earnings. So now we're in the weeds a little bit. And I understand that. Financial term, shut down. No, don't do that. Don't think that way. A multiple of earnings is called a PE ratio. It's how many years of earnings the company must earn to justify the price you just paid. In other words, you want that multiple low. You want a company to be able to, the stock of the company, to have a PE ratio, a multiple ratio of 10 or less. Heck, the market's normally 15, take 15 or less. Graham says take 25 or less, but he's holding forever. That's okay. Just understand that when you pay for something, you're going to live with that for a long time. And a low multiple, a lower price, will make you more successful. Warren Buffett, the enemy of the equity investor, is expenses and emotions. John Bogle said the same thing. These are the experts. These are the people who know. Buffett says, don't lose money. Bogle says, keep your expenses and your emotions in check. Have a process. William Graham says, don't pay too much for the stock. This is no-brainer stuff, guys. This isn't stuff that it takes an advanced degree to understand. Well, what are your choices? You can find a manager who costs 60% at least less than everybody else does and doesn't have a lot of internal expenses. If you need some help with that, holler at me. You can find a teacher or a mentor who wants to get rid of himself. Hello. I believe my job is to get rid of me. I believe your job is to not have to worry about your money in retirement or as you're saving it, which means you want less risk and a lot less cost. If you learn to do it yourself, we have the material, we have the course, and we have the people who can help you, you'll save time and make a lot more money. How much will you save? Well, according to William Bogle, you'll save 100% of what you're saving because he believes that you are going to lose 65% of what you could otherwise save. 65% is more than half. If I'm saving half, then 100%, my expenses will save me 100% of what I've earned. Saving my expenses will save me 100% of what I'm earning. Not too difficult to figure out, really. I did spreadsheet after spreadsheet. I sent it to Excel and Excel experts to make sure that I was not making a mistake. And I show that you're losing 50% of what you might otherwise save if you have 2% expenses, 1% in investments, 1% for your financial advisor. Uncertain? Suppose you watch this and you like it, but you don't know what to do. Well, I'm a no pressure kind of guy. It's your money after all, and your life after all. Book a 20-minute talk with me. We'll talk it over. If it's not right for you, it's not right for you. If I can help you in a different way, I'll help you. I would like to help you to the point where you can get rid of me. Not bad. Write me an email, info@thelaughingretirement. I'll respond to you. We can talk about this. I can help you make this transition. Here are the links for the course. Here are the links to reach me. If you have any questions, let me know. You know, one thing I've learned or noticed about the greats is that they always keep things simple. Now, this is the Pietà. It's in the Vatican. It's in St. Peter's. It is absolutely gorgeous. There are two people there. There aren't 6 or 8 or 10. It's not complicated. There are 2. And we know who they are. The mastery is in the detail. And if you keep your details simple and you master the simplicity of a subject, you too can be successful at it. Investing is generally simple and straightforward. If I own Johnson & Johnson, I can go out and get it. I can see the Q-tips that it makes. If I own Google, I'm not quite sure what it does, and they don't pay me to do it. Johnson & Johnson pays me to own them. I want to thank you. I hope that you will join us and embrace the idea of low-cost, low-risk, diversified investing. We have everything to show you how to do this. We have people who can do it for you. We have the ability to show you from people who are older, individual, single ladies who do this, gentlemen who have been learning for a short period of time, people who have been interested in it for a long period of time. You're joining a group here, not just doing things by yourself. I hope you will join us. My name is Chip Stites. This is the Laughing Retirement. And I hope right now, with the market really high, that you will manage your risks. I wish you well.